Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Welcome to the Alpha Exchange first quarter of 2023 review, in which we assess some of the trends in market risk that have recently been important. We discuss gold, the performance of VIX ETP strategies, and the return of traditional risk-on, risk-off. We also spend some time dissecting changes in the shape of the S&P 500 index volatility skew and commenting on that well-known put-spread collar. We finish with some information on the MacroMinds Investment Symposium, an event taking place on June 7th in New York City that raises critical funding for education-focused charitable organizations. Thank you for listening. The end of Q1 is here, and for me personally, the start of spring is quite a joyous time. Flowers start to bloom, the temp gently nudges incrementally higher, and wonderfully, we are treated to more daylight. I'm reminded of a quote from the great Steve Martin, who once said, quote, "A day without sunshine is like, night. Sunset in and around March 31st at 7:17 or so is nearly 3 hours later than those bad old days of late December when it was as early as 4:28. We lost an hour of sleep, but it was worth it. And as we leapt forward on the clock on Saturday, March 12th, the market got its first taste of true tail risk in quite some time. On Thursday, March 10th, SIVB traded nearly 39 million shares versus an average volume well south of 1 million shares per day. The stock fell by 70% in a single day. The next day, it was gone. Poof. Working furiously over the weekend on deciding what to do, one can envision regulators at the FDIC and Treasury lamenting their bad luck of having to deal with the second and third largest bank failures in history over a weekend that daylight savings stole a precious hour from them. Oh well. I often say that risk management suffers from a failure of the imagination. We earnestly build systems of defense that contemplate bad outcomes, creating scenarios that shock prices in wayward directions. These unwelcome episodes are well trodden along the path of risk management. There's the LTCM unwind, the tech crash, the GFC scenario, the sovereign debt crisis. We might throw an oil shock in there, but that asks us to go back a long ways. And of course, we fail to appreciate the dangers of inflation. We are prone to the dangers of extrapolating current conditions into the future. And as 2021 was upon us, year-over-year CPI was a meager 1.4%. We, and especially policymakers, missed the forest for the trees. Incredibly, as 2022 began, with that same year-over-year CPI metric now at 7%, the yield on a 3-month Treasury bill was just 3 basis points. An overlay of these two series illustrates the staggering disconnect between the stance of policy and the inflation facts on the ground in early 2022. Policymaking is tough stuff. Fed criticism makes for easy sport. And we should remember that just as Powell and company were very late, investors missed the market pricing and correlation implications of policy that had fallen so far behind. For years, the dominant underpinning of the framework for institutional portfolio construction was the negative correlation between stock and bond prices. Risk on, risk off had been a thing in markets for the better part of 2 decades, and investors banked the risk reduction that came from the zigging and zagging of equities and bonds. It was easy to argue that by late 2021, with stocks at some of the most elevated valuations in history, with the 10-year yielding 1.5%, and with inflation, as mentioned, at 7%, something had to give. It may have been obvious looking at these disconnects, but that doesn't mean that there were easy decisions to make for those managing capital through this period. Risk management does indeed suffer from a failure of the imagination. And related, I like to say that the next crisis to occur is the one that happened longest ago. Investors are prone to recency bias, and the ability to fully appreciate changes in risk regimes is challenging because of a lack of recent experience with the data. Simply put, without the misbehavior of market prices, our internal distribution of what is possible is compromised. We are left believing that tomorrow will unfold much like today has. The stress test imposed on banks contemplated a cratering economy and the credit risk of loans gone bad. They did not, however, contemplate the losses from buying duration in outlandishly overvalued risk-free bonds. Apparently, Bill Gross's idea to shake hands with the Fed and buy what it is buying did not work out for Silicon Valley Bank. With this little intro behind us, let's get into some review of what's happened in the world of risk in the first quarter of 2023. First, a couple of victory laps are in order. As you are well aware, the broken clock is indeed correct twice daily. You may also be aware that I have forecast 9 of the last 4 episodes of Financial Market Crisis. But as we start the second quarter, 2 of the 3 main calls from our year-end podcast have played out quite well, and the third wasn't bad either. Let's first start with gold. That barbarous relic is a funny thing. It's often said to be an inflation hedge. Some suggest it is a deflation hedge. It's easy to argue that it is neither. Gold tends to be correlated to both the dollar and rates. When rates travel higher, as they did in 2022, in response to the Fed, which is in turn responding to inflation, gold tends not to perform well. In 2022, gold was down slightly, not bad at all given what happened in stock and bond markets, but it hardly hedged the inflation that shocked the Fed and brought about one of its most aggressive hiking cycles in history. Is gold a deflation hedge? Well, deflationary events are a lot of things, but one characteristic is a dollar spike. October 2008 and those dark days in March of 2020 come to mind. Priced in dollars, gold will buckle when the wheels truly come off the bus. Gold, like treasury bonds, was a source of capital that had to be liquidated over that wild week 3 years back. Over a brutal 9-day period, the DXY surged 9%. The S&P, TLT, and GLD fell by 16, 7, and 11% respectively over the same period. Nothing except vol itself is anti-fragile in a deflationary liquidation. So back to the gold call. By the end of 2022, we were observing the very unique correlation environment the market had become mired in. On one side of the ledger, rates and the dollar. On the other side, most everything else. The correlation flip between stock and bond prices got a lot of attention. The S&P and TLT were 9% positively correlated for the year, but 22% positively correlated the second half and 27% during the last quarter. The dollar correlations were even more interesting. Over the last quarter in 2022, the dollar was more negatively correlated to the S&P than the VIX was. As the rising USD imparted itself on asset markets, on yen, on gilts, on gold, we can say that the dollar became a kind of international VIX. These troublesome correlations were not the stuff that risk management dreams are made of. And a lot of portfolio construction is about finding assets that exhibit low co-movement. As this Fed hiking cycle got further extended, we argued that gold could do well in several risk scenarios, and given its relatively modest correlation to the broad market, was worthy of holding. What are these scenarios? From a 4-quadrant standpoint, rates in the dollar up or down, and stocks up or down. The first of these scenarios, one in which both rates and the dollar continued their march higher and stocks somehow decided to follow, appeared very unlikely. The second, rates in the dollar up and stocks down, would not likely be good for gold, just as it hadn't been. Gold and stocks had become much more correlated to each other last year because they shared a common driver, their high correlations to the dollar and rates. This leaves us with the last 2 quadrants. First, rates in the dollar down and stocks up. If rising rates and a stronger dollar acted as a stranglehold on risk-taking, then their retreat could serve as a relief valve. This is exactly what happened in the combination of softer Fed communication and a benign October CPI report. From that data release to the end of 2022, the dollar fell by 6.5%, and the S&P, TLT, and GLD rose by 2.4, 5.2, and 6.9%, respectively. But it was the final quadrant that was most on my mind in advocating for gold at year-end. And that was the return of the classic risk-on, risk-off, in which stocks fell while bonds rallied. These episodes, as long as they do not bring us to the liquidation precipice of an October '08 or March of '20, are excellent for gold at the very time when they are bad for stocks. Finding an asset that could serve as a ballast for risk exposure in this scenario is important. A few examples include 2011, the famous U.S. debt ceiling charade, more on that later, as well as the European sovereign crisis, and 2018, Powell's mistake and pivot. U.S. real rates fell by 67 basis points from June to November of 2011, They fell by 40 basis points from November 18 to March 19. Gold did exceptionally well during this period as stocks faltered. And of course, this is what we've gotten from SIVB. Since March 8th, the dollar is down nearly 3% and 10-year yields are down by 45 basis points. Gold is up 9%. Stocks are up slightly, but felt very risky as the VIX pushed past 30 on March 13th. With gold up 8.5% year to date, it's somewhat of a tougher call going forward. Prices have moved higher, as has the implied volatility that also served as a very attractive component of our trade construction. That said, as highlighted just before, one of gold's most glorious periods was around the debt ceiling showdown in 2011. The debt ceiling debate is the ultimate example of, quote, wake me up using the alarm clock of market prices. Policymakers won't move until the market forces them to. Recent reporting by Bloomberg on the debt ceiling is disheartening, though completely unsurprising. McCarthy sends a scathing letter to Biden demanding a talk. The White House comes back almost immediately with a stop putting the country at risk statement. When these two last met, it was February 1st. 2 months have gone by and nothing at all has occurred except a mini banking dust-up. Experts like Libby Cantrill from PIMCO will say that 2023 is not the same as 2011 in that the Tea Party faction in the Republican wing is considerably smaller now, though probably further to the right. The same leverage isn't there this time around. But we ought to pay close attention to this. Market prices can turn on a dime, and the psychology of fear can be powerful. We'd learned in 2011 that vol can quickly blow out and that safe haven assets like gold can surge. Another big difference now versus 2011 is interest rate volatility. 3-month, 2-year swaption vol was north of 200 normal vols, well above the pandemic high. In July of 2011, this metric was just 54. So we approach this potential showdown with deeply unstable, risk-free markets. The second idea we proposed was generating carry via a short position in the VXX. We asked out loud, what more can be said of a long vol product that managed to lose more than 20% even as the S&P also lost nearly 20%? Of course, there's always the risk of blowup that should be heavily weighted when shorting VIX ETPs. But as we were turning the page on a new year, 3 favorable factors were in place. First, the level of implied volatility on the index side was on the higher side, with at least some room to potentially retreat. While it worked really well throughout 2017, a short in the VIX ETP complex was increasingly dicey as the VIX descended below 10, leaving very little margin of safety. Second, the term structure ended 2022 in S&P vol in its natural resting place, contango. The roll down effect in VIX ETPs is similar to what folks like Bill Gross always loved about an upward sloping U.S. Treasury yield curve. In the equity derivatives context, the passage of time provides an extra source of return as VIX futures prices roll down to the spot VIX. Markets in contango tend to stay there, but for some realization of a shock. Lastly, a short in the VIX ETP complex was worthy of a look because the options market allowed for truncation of losses should a spike in vol materialize. For reasons cited, mostly because movements in the VIX were on the muted side in 2022, more on that later, the implied vol of vol was at one of its lowest levels on record. Thus, a short position in a VIX ETP could be paired with an upside call at favorable levels. Q1 2023 ends with the VXX loss approaching 20%. Importantly, and as correctly identified, the upside call was cheap protection against the SIVB risk-off. In just a week in mid-March, the VVIX surged from 75 to 122. It was the market becoming reacquainted with left tail risk, assigning higher probabilities to bad outcomes and willing to pay up to hedge them. And this leads us to our last topic, the shape of the S&P vol skew. First, a short treatise on skew. Having just done a podcast commemorating the 25th anniversary of LTCM with Nicholas Dunbar, the author of Inventing Money, I've been thinking more than usual about option pricing in theory and practice. Just as the LTCM event turns 25, the seminal Black-Scholes paper has its 50th anniversary. There are a number of simplifying assumptions that make the Black-Scholes math work, some of which matter more than others. They assume away taxes, for example, which would be wonderful in real life. It turns out, however, to be a pretty benign assumption with respect to the formula. The three biggies are that markets are frictionless and that trading can be done at any size instantaneously, that volatility is known and constant, and that stock returns are normally distributed. The breakdown of each of these assumptions figures into the demise of LTCM. In a purely Black-Scholes world, the VIX doesn't range from 8 to 80. And similarly, if stock returns were actually governed by the normal distribution, episodes like the 87 stock market crash essentially become a mathematical impossibility. The model is certainly not perfect. And that leads us back to skew, a term that helps describe the pricing of options across different strike prices. Because markets do gap down and do go through periods when potentially terrible scenarios increase in probability, there are times when the demand for insurance increases markedly, driving up the price of out-of-the-money puts. The result is a steeper strike skew, measured as the difference in implied volatility for an out-of-the-money put versus an at-the-money put. In the S&P, this strike skew in 2022 saw better days. In fact, it was a widely discussed phenomenon among derivative market participants. I like to ask, who ate the vol skew to initiate discussion about the meager premium of out-of-the-money put vol to at-the-money vol during a year that the S&P fell by 18% and bonds failed spectacularly as a hedge? One way to frame this out is to look at the premium of the VIX to at-the-money one-month implied volatility in the S&P. The VIX, celebrating its 30th anniversary this year, by the way, is a measure that incorporates a range of strikes in its calculation, with meaningful weight on downside strikes. What do we see in 2022? The VIX premium to at-the-money vol was at just 13%, well below the 10-year average of 22%. Why? The answer ties back to the original discussion on how market prices impact our behavior. There's no better motivator than P&L. And for those investors using far out-of-the-money puts to hedge equity exposure in 2022, by mid-year it was clear that something wasn't working. We mentioned the incredible fact that both the VXX and S&P fell by nearly 20% last year. Another way to see how hedging strategies failed to cushion the blow of the material downturn in the index. Experiencing poor results from owning downside protection, investors reacted, ditching these trades in favor of simply de-risking or in running Delta One short overlays that didn't bleed option premium. The result? A flattening of the volatility skew as demand for this out-of-the-money protection decreased. As 2022 ended, we put forth a third idea that rounded out the long gold and short VXX calls. And that was to buy the same strike skew we just described as performing so poorly last year. From a risk management standpoint, this flat skew provided some of the best economics for entry into the collar strategy, long and out-of-the-money put financed by an out-of-the-money call on the S&P in decades. Indeed, the CSFB index, ironically now it appears, an acronym for Credit Suisse Fear Barometer, closed at 13 at the end of 2022. This index calculates the strike of a 3-month put on the S&P 500 that has the same price as a 3-month 10% out-of-the-money call. Thus, an index value of 13 means that the 87 110 collar was zero cost and a very compelling trade-off between downside and upside risk versus historical pricing. Given the flatness of this skew, we argued that the straight collar provided more value than the put spread collar, another common hedge that offsets the premium of a put spread with a sold out-of-the-money call. In finance, you don't get something for nothing, and the trade-off between these two is clear. The put spread collar enjoys a higher call strike but less protection should a significant risk-off materialize. As we record this, the largest index hedging trade in the market, the well-known, well-anticipated, and well-studied quarterly S&P 500 put spread collar initiated by JP Morgan, has just been rolled. The pricing setup as 2022 rolled off was compelling to move away from the put spread into the straight collar as a function of how little premium was generated by selling the 80% put. The quote, disrespect, in the words of Robert Bogutsky, shown that deep OTM put was more a function of the bad experience investors had owning it last year than its potential value and utility on a going forward basis. Another factor was key in collar pricing late last year, and that is how handsomely the market was willing to pay for upside volatility. Perhaps a function of the incredible one-day jolt higher in the S&P on November 10th. By year-end, the 105 call was 20.3 vol bid, just 4 vols under the 95% put vol. This tight spread was in the 6th percentile of observations over a decade. So now what? JP Morgan is bound to execute a specific zero-cost put spread collar, of course. The economics of the latest roll appear to be slightly worse than the roll executed at the end of 2022, as the zero-cost call strike is about 80 basis points lower. This is largely a function of the weaker implied vol bid on the call, now around 15.5%, almost 5 vols lower than at year-end. What's that 5 vols worth? It reduces the option price by 35%. So here's an idea that I think more efficiently, quote, takes what the vol surface gives you. Sell only half the call position and nudge the strike down from 5 to 3. And in keeping with the zero-cost mandate of the collar, move the put spread a bit further out of the money, utilizing the lesser amount of call premium generated. Roughly, this would amount to something around the 93.79 put spread. So what trade-offs have we taken on? We lowered the call strike from 5% to 3%, so our long exposure is capped earlier. But we've halved the short call position. So while capped lower, we are only capped on half the amount of our long exposure. If the market runs strongly, this turns out better. We also lowered the attachment point of the put from 95 to 93, and the put spread is now 14% wide rather than 15%. So why tinker with these strikes? Mostly to reduce the short volatility profile of the collar. Think about the collar as a 5% out of the money put, fully financed by the sale, roughly, of an 80-105 strangle. As market prices have settled in post the SIVB event, it's less than obvious that a seller of this strangle is being well compensated to be short both upside and downside tails in the S&P. The JP Morgan collar mandate appears constrained to be an overlay that has zero premium outlay. So there's only so much tinkering that can be done. But we got a small taste recently of a change in character of risk over the past 3 weeks, and I would argue that market movements have become more financialized versus 2022. Now it's the classic risk-off where bonds rally and tails get bid. One way to see this is in the increased beta of the VIX to movements in the S&P 500. A common question asked last year in markets was, is the VIX broken? While most asking this presumably understand that the VIX is merely a calculation engine that is instantaneously repriced based on a specific protocol of dates, weights, strikes, and expiries, the question arose because of the muted beta of the VIX to the S&P. Indeed, in 2022, for example, there were 8 instances when the S&P fell by more than 2% and the VIX failed to rise by more than 2 points. Going all the way back to 2012, there are only 9 additional such occurrences. Similarly, over the 10-year period ending in 2022, there were 6 days when the S&P rose by 2% or more and the VIX fell by less than a point. 4 of those occurred in 2022. So what has happened recently? The uncertainty around SIVB has rekindled fears of the left tail and pushed the VIX beta considerably higher. A simple regression of daily percent changes of the VIX to the S&P in 2022 yielded a beta of minus 3.5. That is, a 1% move lower in the S&P would push the VIX higher by 3.5%. On an average VIX of 25.5 last year, that equates to a 1-point increase in the VIX. Over the month of March of 2023, this beta has increased markedly, with a 1% move in the S&P associated with a more than 6% move in the VIX. Related to this, the recent bout of market unease brought with it a 48% surge in the VVIX over just 5 days, the largest surge since the most intense period of the pandemic in March of 20. Capturing the implied volatility of VIX options, the VVIX move from 75 to north of 120 illustrated how much demand there was for this type of protection. We say this often, but vol is just about the only anti-fragile asset in markets. It not only survives a full-on liquidation, but actually gets stronger in the process, as evidenced by its surpassing 80 in both the GFC and the pandemic market meltdowns. VIX options are a vehicle often used to cover very far out of the money exposure. There's nothing that can spike as quickly as short-dated index volatility. The recommendation on restructuring the JP Morgan put spread collar on the S&P is really about reducing the net short vol exposure in the trade. We have just experienced one of the most dramatic periods in interest rate vol in market history. The yield on the 2-year note traveled from 4.1 to 5.1% in a month, from February 1st to March 8th, and by March 15th, incredibly, was below 4%. The 87 stock market crash is the only time of comparable volatility in this asset class we generously refer to as, quote, risk-free. Since implied vol follows realized vol, there's no heroic insight in guessing that swaption vol went through the roof. 1 month, 1 year swaption vol tripled over the course of 5 days. If the VIX went from 20 to 60 in 5 days, would we notice? What might that do to trades in the market that underwrote this as an impossibility? And what would be the liquidity fallout? Swaption vols have receded a fair bit from these extraordinary levels, but there are far-reaching implications, none of which are positive for equity markets. The price of tails is about widening the market's distribution of what is possible. As difficult as 2022 was from a delta standpoint, there was just very little probability assigned to deep tail outcomes. We saw that in the S&P flat strike skew, in the muted moves of the VIX, and in the very low VVIX. I'd argue that this is in the process of changing. If there's a single thing to be learned from crisis events, it is that when fear becomes the overriding factor, capital can run quickly and further destabilize a situation. Fear is driven by our inability to handicap outcomes. When we have to assign greater probability to low delta but high impact events, risk-taking can become further hampered. As the Fed seeks to satisfy the impossible trinity of monetary policy, the trilemma of inflation, growth, and market stability, the world is confronted with an awful backdrop of geopolitical risk and U.S. political dysfunction that almost surely leads to a debt ceiling showdown. It's a fairly toxic brew set against the VIX below 20, even as realized volatility remains healthy enough to provide a floor to implied volatility. Well, that's it for the first quarter Alpha Exchange review. Before I let you go, I'd like to share with you some of my work on behalf of MacroMinds, the foundation I launched in 2019 to bring the investment community together in support of student education. We've been working hard on our 2023 Investment Symposium to be held on June 7th at the beautiful Times Center in New York City. It's shaping up to be a truly great day, and I hope you can be involved. Our business model is to host a once-yearly symposium that features leaders in the investment industry who share their insights on the always changing landscape of risk and return. Among the topics of discussion are monetary policy, regulatory change, the cost of hedging, the growth of digital assets, the path of inflation, and where investors are best compensated to bear risk. We've got truly world-class speakers participating in the symposium, generously lending their time and insights. I could not be more appreciative. I also believe that the ROI from a day away from the screens is highest when we are not just listening to experts, but also strengthening existing business relationships and building new ones. Establishing rapport, I like to say, is strictly an in-person pursuit. After all, it's the spontaneous collaboration that occurs during lunch, coffee breaks, and my favorite, the post-event reception, that can be really valuable. To that end, our attendees will be from the buy side, the sell side, and from the allocator community. MacroMinds is founded on the idea of facilitating relationship building among focused senior professionals who are really on their games. At the event will be portfolio managers, chief investment officers, chief risk officers, heads of strategy efforts and various trading desks, traders, sales traders, heads of asset allocation, and heads of manager selection. We come together as an industry to support 3 organizations that are focused on student education. This year, we are really excited and honored to be partnering with the Children's Scholarship Fund, Futures and Options, and Invest in Girls. It's almost exactly 3 years ago that the pandemic shutdown occurred. Thankfully, most parts of our lives and the economy are back up and running. Of the many truly difficult outcomes, however, over these past 3 years, has been the significant negative impact on education for students, especially for students from families and communities with less resources. Our efforts as an industry on June 7th push back on this. I kindly ask that you help us raise awareness. We have a growing list of sponsors, and if you believe your firm might find value in a sponsorship, please do raise the question internally. Please also visit our website, www.macrominds.org, and check out the tab called Get Involved. It's going to be a really exciting and inspiring day, and I hope to see you there. Well, that's it for me, and thanks for listening. You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.